Everything is awesome. It's Wednesday, August 30th, 2023. This is Overtime. I'm your host, Chris Vecchio, head of Futures and Forex here at tastylive, joined, of course, by the one and only Ilya Spivak, head of Global Macro. Ilya, happy hump day.
It's not a happy one for the dollar today, I'll tell you this much. I'm sweating a little bit in my positions. I haven't abandoned ship yet, but that pound is mighty strong today. And the euro is not too shabby either, none of which are things I like.
That all comports with the technical turnaround that we saw yesterday brewing in the dollar index, and quite frankly, an extension of the price action following from yesterday's JOLTS report. The U.S. labor market is showing signs of normalizing, which may be a good thing if you're concerned about further Fed rate hikes. But there is someone that we should talk to about this, Mr. Spivak, and that would be the one and only Dylan Ratigan, who is now joining us on Wednesdays as our special guest here on Overtime. Dylan, good to see you again.
Well, it's interesting because your introduction last week, where you were, it was a pie. I think your first words out of your mouth was UGLY. That's my second appearance now. You're saying everything is beautiful, so I feel like you're prone, Chris, to mild hyperbole.
Perhaps. Maybe that's what gets the engagement. I also just watched the Lego movie with my daughter yesterday, so the Everything is Awesome song has kind of been rattling around in my head. Yeah. I incorporate far too many nursery rhymes into my introductions for these shows, but that kind of shows that I have a toddler at home. Dylan, this market has really turned around over the past, we could call it, 36 hours now, following a slew of U.S. labor market data. The JOLTS report yesterday showed that job openings fell to somewhere in the mid 8 millions, which is a serious decline relative to expectations, and a further decline from the peak that we were at during the pandemic. Now there's about 1.5 job openings for every unemployed person. That's off from over 2 previously, a very high level historically. But I guess my question for you is, do you feel, even though inflation has come down, that the Fed is right to continue to pursue their goal in trying to hurt the labor market in order to achieve the goal of defeating inflation?
I mean, to say that the Fed is right or wrong about anything at this point is a bigger question, I think, than can be resolved in this moment, because I think the entire mechanism of the way rates are sent is preposterous. Like, there's a whole architectural issue here with the central bank and the fact that markets really set rates and the Fed chases them, and there's a whole chicken and egg thing there. But if you're asking me, is it if in a battle between the labor market and the employment and inflation, which takes primacy, and any economist will tell you that inflation takes primacy, because if you compromise the currency, you compromise everything. And any human being will tell you that the labor market takes primacy because you can't eat math. You can only, you have to have, human beings need work. And so long term, I would say, as a non-humanist long term, obviously the Fed is correct to be ruthless with inflation, because the foundation of all U.S. economic power globally is based on both the reserve currency and currency primacy and currency stability and the absence of inflation. And so that is the core, that and the U.S. military is the source of total U.S. domination of the world. Is it good for people? No. In the short term, no. Are they right to do it? Yeah, to the extent to which the government's job is to ensure the stability, long-term stability of the country. If that comes with some short-term stress for human beings, yeah, they're right to do that. But it's a shitty system.
Dylan, I then wonder about the climate that we're heading into. It is getting close to Labor Day, which means it's just about time to start paying attention to politics once more. We may not have midterm elections this fall, but the presidential election cycle is starting to heat up. If you like it or not, it happens every 4 years. Do you think there's going to be a little bit of political pressure on the Fed moving forward, where if they get inflation close enough to 2, producing a recession, producing a rapid spike in unemployment may be something that, say, the current president won't be on board with? And for some background, Biden wouldn't be the first president to apply pressure to the Fed, just like Trump wasn't the first president to apply pressure to the Fed. This goes back to the Volcker years, quite frankly, when Reagan was asking Volcker to cut rates heading into the election. So this has been going on from, we could say, Reagan, you could even argue with Nixon, but any president since then has applied some degree, public or private, pressure to the Federal Reserve chairman.
Yeah, I mean, I would say if anything, obviously I agree with your characterization, but I would say if anything, there's enough time on the clock that if anything, the Fed is likely to be more aggressive sooner now to try to get it out of the way so that they're not forced to have to make a hard decision come March, June of next year when it really is in the heat of the presidential battle. So I would actually argue that the Federal Reserve is more likely to be more aggressive over the next 3 or 4 months than they would otherwise be because of the presidential election.
I saw a survey today showing that Americans are less confident and optimistic about the economy today than they were back in the late 1970s when inflation was up double digits. They're less confident than they were in the early 1980s when inflation was back in the double-digit territory. And so it's fascinating how people's feelings, obviously they change over time as information is disseminated quicker and we probably know far too much about each other and the world around us. But this cost of living crisis, if it's here in the United States or in the UK or across the Eurozone, it is having political ramifications. And our election could very well be one that ultimately is swayed by this. Ilya, I know that you and I have been talking about the housing market a lot recently. Yes. You published a piece to the tastylive Traders blog last week about the housing market. I did a follow-up to what you wrote here today. From my vantage point, it looks like supply is going to remain constrained for the foreseeable future. Why don't you provide a little bit of backdrop and tee Dylan up here with the state of the housing market in the United States?
Sure. Well, this actually connects very well to the conversation about inflation, because if you look at sort of what the Fed is focused on here, and you hear them constantly talk about services X housing, right? Why are they excluding housing? Housing is actually the largest component of service sector inflation at this point, by far. But what it is this measure that they use called imputed owner-occupier rent. So they're essentially saying, if we were to pretend that you're paying rent and you don't own your home, and if we were to pretend that you haven't locked in a 30-year mortgage for most Americans, and we pretend that you're paying market rates for housing that move with markets, though you live here now and your costs are fixed, then inflation is very high. And obviously, even if they didn't take these liberties, there's not very much that the Fed can do with raising rates to impact near-term housing realities, right? The housing market is slow. It takes a while for things to be built. It takes a while for them to change hands. And so the Fed is focused on the labor market because that's the part where they can create some near-term action. And that's the second largest component of all of this. But on the housing side of things, there is a kind of slow-moving shift where if you look at the fundamental issue, everybody's been screaming about, new home sales are picking up. New home sales are a tiny, tiny fraction of the U.S. housing market. The overwhelming majority is existing homes. So we're talking, for the last set of numbers, about less than a million new home sales sold. Existing home sales are closer to 4 million. So vastly different magnitudes here. And the issue seems to be that the price is holding up because the thing is fundamentally illiquid. So at this point, inventories are down to just 1 million homes. That's the lowest that we've seen them in at least 20 years, give or take. So it seems like you have this situation where nobody is selling. And that makes sense because those mortgage rates that people have locked in, the average rate on an outstanding U.S. mortgage right now is 3.6%. That's 4% lower than going mortgage rates. So who exactly is rushing out to say, you know what, I'm going to sell and then I'm going to finance something 4% higher? So inventories seem to be really, really low. And so the question becomes, what needs to happen here? Is it a mortgage rate thing? Does the mortgage rate need to come down? And do we need to wait for the Fed for this adjustment? How do we fix this imbalance? Because clearly the problem in housing appears to be that the Fed, Dylan, to your point, is not probably going to run away from the inflation fight here, at least near term. And they can't really do anything about the housing side of it. So what needs to happen here to address this? Because this is a part of the affordability puzzle, the inflation puzzle, the cost of living puzzle, everything.
Yeah, I mean, I think that I have a number of thoughts on this, as I suppose most people do. But I would say that the housing market is basically central in the corruption of the entire American economic and political system, because the vast majority, all the houses are really owned by the banks. The propagandization of the American consumer as the need to have a mortgage and own a house as being evidence of the surest way to secure your position in the middle class and wealth and all these things, have created a situation where the obvious solution is for housing prices to come down, right? And in any normal functioning market, housing prices wouldn't be where they are right now anyway. Housing prices are only where they are right now because of what happened with interest rates the last 10 years, what happened with COVID, what happened with building, and all the cultural dynamics, and all of the financial incentives for people who do have some home equity to then, the number of people that own 10 houses that they rent out on Airbnb is, the more that happens, to me, that's more and more evidence of a dysfunctional market, because you have more and more people that are not able to buy a single home, as you have other people that are leveraging imaginary or equity to then accrue more leverage to then, pump the system more full of hot air. So anyway, the short answer is housing prices should come down 30%, right?
I would agree.
And then it would clear. The lie, everybody's like, oh, housing prices haven't come down at all because no one is selling, right? There's no transaction to be had. And the last thing that the last thing that the banks want is for housing prices to come down 30%, because so much of their entire equity base that they lend against is based on the equity value of the housing that they have claims on. So if you were to adjust the housing market, you would then adjust the entire banking market, which would then create a massive credit contraction, which would then create a massive issue with the pensions that are invested. It starts to go into a death spiral. And so, which leaves you with, okay. You're like, okay, we're not going to go into that room. So then you get to the other meeting, which is, okay, let's just build a lot more houses, right? Which then goes to the home builders. You're like, no one's going to sell anything because no one wants to deal with the rates and they can't adjust the price, and it's a jam job. But what we can do is just create more houses that don't have the hangover, they don't have the legacy, all the rest of that. And there's a tremendous amount of logic, functionally, to that, in my opinion, but it's not going to happen quickly. It's not going to happen fast enough, all the things. And so it leads me to sort of buy into the thesis. When people say, oh, well, the home builders are a good investment, I tend to agree with them. Not even though, again, the reason they're a good investment is because the market is broken. And so they're like a bypass to the broken market. But the only solution to inflation is for the Fed to be aggressive on employment. But as the Fed is aggressive on employment, that's when you'll start to get mortgage defaults, because the thing that allows the housing market to last in perpetuity is, regardless of household credit net worth or credit card debt and all the things, as long as there's a paycheck this week, next week, the next week, can make the payment for this month, and everything kind of keeps going. And so the logical outcome here is a meaningful price adjustment in housing. The logical outcome is a meaningful increase in the unemployment rate. And only both of those things will ultimately reduce inflation.
I would agree.
But it's both of those things. And if you basically punish, this is where it goes back to my initial discussion of the macroeconomists versus human beings. If you try to solve the entire inflation problem by doing it in the labor market because you're terrified of actually seeing a price adjustment in the housing market, now you're basically putting the burden of the enrichment of the generation that is in deep into the housing market on those who work. Anyway, all of this is just sort of a lousy social cycle, but I do think that it's very good for the new home builders as a stock price. Other than the fact, and I'm looking at Chris's chart here, there may be a certain degree to which this entire narrative is already embedded in the price appreciation that we're looking at.
I certainly think it is. I mean, home builders have been on fire this year. They've outpaced the S&P 500 by nearly 20% thus far year to date. We've seen that they've weathered a jump in mortgage rates, not just from last year, but through this year as well. Home builders continue to go up. They're up over 4% this week so far. ITB, the home construction ETF. You could also look at something like XHB, which is slightly different weightings. It's less concentrated. It has more, should we say, home furnitures in there, right? Like a Sherwin-Williams, for example, would be in the other ETF. Which, if you're painting, you get a new home, you're probably going to want to paint it, as it were. But home builders, to me, I mean, this has just been another trade on interest rates. Plain and simple, right? They've weathered the storm as rates have gone up, and now that rates have just ticked down ever so slightly here the past 2 days, they've started to moon once more. And that speaks to the entire dynamic right now. The second there is any relief on the mortgage front, people are going to come in. Millennials are actually forming homes now. Over 50% of millennials own a home. And this is the biggest demographic cohort of the U.S. population right now. So as those prime house building, house formation years roll forward, the demand for housing will remain there. It's going to take a while. New home sales, as you said, Elliot, take some time. These are illiquid markets. Building takes a little while. We can't solve this overnight. How much of this is a policy problem, Dylan? I can think about my time living in New York City, and you can't avoid a community board meeting. We can go into the psychosis.
San Francisco, identify wholeheartedly.
We can go into my psychosis as to why I'm spending my weekday nights in community board meetings. That's a whole problem unto itself. But there are clearly strong divisions, YIMBYs, NIMBYs. Yes, in my backyard, not in my backyard. People are fighting tooth and nail, and zoning regulations are such that even if you want to build something, the chances of you getting done can't really get done. Do we need just a significant tape cutting exercise in government at all levels, municipal, state, federal, to really kickstart building once more?
Again, the housing market, logically, like there were basically two things that happened after World War II. One was Eisenhower was the president. And one, the American healthcare system was contrived at that point in time. And two, the American mortgage finance system was contrived at that point in time. And I am prone to believe that both of them were well-intended. There was not an appetite to structure a healthcare system. Eisenhower was he's like, listen, if you have a job, then make the employers give people health care. I'm not going to make it a government problem. And it basically was the origin of the employer-based health care system, which is an unadulterated catastrophe. I mean, beyond catastrophic, both in cost and in performance. It's not it's the worst healthcare system in the world by pricing and structure and flexibility. It's just abominable. And the same thing with the policy on housing, where housing does not price at the value of housing. Housing prices at the political value of social stability through wealth creation, through financial shenanigans with the banks, and basically the cash flow of people's W-2 income to the banks in exchange for the use of a house under the construct that they own something. But none of it's a price. Like so it's not just the rent control issue or the red tape of the co-op boards in New York or any of the misery in San Francisco and sort of the obvious absurdities, but the entire pricing is completely out of control. But it's also something that, barring an extreme catastrophe, will be perpetuated, ad nauseum, because of its political value. And the thing is, you talk about the presidential debate, Chris, doesn't matter, right? Whether it's the Republican Party or the differences between any of the political parties in the United States tend to be superficial and social in nature. And there is almost no structural difference when it comes to something like housing, rates, equity, let alone healthcare, et cetera. And so, my inclination is to go along with the path of least resistance, which is to assume that the basic corruption of the system will perpetuate indefinitely and, be long that system, right? You're better to be inside of that corrupt system and participate in the appreciation than to be in defiance of it. Even if there's a little bit too much price appreciation in this chart here with the new home builders, again, what's your alternative? Are you going to get people that are in, $2 million houses, or, whose paper value is $2 million, which is, an absurdity anyway for most of these houses, but whose payment to buy it has doubled or tripled in price? So the very same homeowner could never buy the house that they're now in. So they'd have to sell the house that they're in and then buy a house that's half the price of the one that they just sold. Like, they're not going to do it. So then you need people either to get fired, divorced, or, you need death, divorce, or termination are the only catalyst for an existing home sale, or you have to wait it out. All of which I just think is extremely good for anybody, whether it's somebody who's selling appliances for new homes. I mean, it's all those things. And I'm sure the renovations are like everything that has to do with not selling your house and keeping your house will perpetuate itself indefinitely at this point, because it's a prison of our own creation. There's no alternative.
Hotel California, right? Once you check in,
the entire American housing market is Hotel California.
Dylan, the housing market. Oh, sorry. Go ahead.
I'm just positing. It's interesting how this lines up with the gates that some of these big asset managers have put on their real estate funds, because their reaction function might be a little bit more active than your garden variety homeowner. And obviously they hold a tremendous inventory of things, sort of the BlackRocks of the world. So you kind of, it makes you wonder where their divestment threshold is, because if we look at housing starts, building permits, they're very pointedly rising at this point. So the very last numbers for July had housing starts growing at 5.9% year on year. That's the highest that we've seen since basically the first quarter, second quarter, let's call it first half of last year. So still early in the Fed tightening cycle, a little bit before. So before mortgage rates did the meat of their rising. So there's very clearly this idea that, okay, we're going to put more supply on the market. On average, Census Bureau estimates 7 to 12 months to finish a single unit of single family housing in the U.S. So you figure, okay, a bunch more supply is somewhere next year. when it hits. If we're starting to see the pickup now, then sometime into next year we should see a bunch more new housing. If that's what's coming at the same time that you have unemployment start to bite, people start to default on mortgages.
But you also have rates
maybe
coming
there's something
down
there
at that time, theoretically.
Yes. Well, yes. And so this then is the sequencing, right? Because the housing market is so slow, you get these pockets where it's a really terrible time because rates are high, but prices haven't fallen yet. And then there's really great times like late 2011, early 2012, where the price hasn't rebounded yet, but rates are still low because they've already been cut. And so the stock market would respond in, let's say, 2009. Housing didn't bottom until 2.5 years later. So because the turnover is so slow, liquidity is so slow to change hands. So you figure exactly, maybe what you have in, let's say, 2-3 years' time is this kind of a perfect storm where a bunch of new supply is coming that starts to water down the price a little. Maybe some of these holdouts then sell as mortgage rates come down and the affordability of something else gets better. And the X factor then is, does it fall fast enough for somebody like a BlackRock to say, you know what, let's lift the gate? And if they lift the gate, then who knows how ugly that gets, but it's unclear that they would.
Well, the other thing I was thinking while you're talking, Ilya, is there may be an irony as rates come back in, because when the mortgage rate is whatever it is, 7.5% or something, 7% up from 3.5%, no one's selling anything unless they're really, really jammed into the sale, right? Like it's just no way.
Exactly.
Let's say you bring rates back to 5.5%. Like my guess, what I'm getting at is a rate that supports more liquidity actually might drive a faster market adjustment to a lower per square foot housing price. Ironically,
I think that makes sense.
Because you get more clearing in the market.
I think that makes a lot of sense. I think that makes a ton of sense. If these things line up with new construction coming on steam, then you could get a sort of long-term, let's give the next generation at least a working shot at wealth creation kind of window, sort of like we had in 2012-ish.
Yeah, but imagine you jam, the unemployment rate goes up, all the new homes come online, and rates backpedal a couple hundred basis points where the market can start to clear.
Yeah.
I sold my loft in New York, by the way, in the fall of 2012. So every time you talk about that as having been the worst possible time to sell something, Ilya, I have a small agitation in my heart.
It's funny because that's right when I bought my condo, which I could never imagine buying today.
Well, you guys are talking about this housing market problem here in the United States. In terms of percentage of household wealth, home equity is about 30% of an individual or a family's overall wealth. That's low compared to China. It's about 70% in China. China's real estate market is about 30% of their entire GDP. Here in the United States, real estate's only about 17%. It's still a fairly large component, but China's obviously going through a unique issue. While they're going through these problems, as it were, having their time in the barrel, I couldn't help but notice, Dylan, that we've seen another U.S. official from the Biden administration make a trip over there. Commerce Secretary Gina Raimondo was just over in Beijing the past few days. This is not the first time that a Biden administration official has been over there in recent months. There seem to be more overtures to try to mend some fences here with China while they're going through a period of difficulty. Do you see this as political posturing, or do you see this as a legitimate attempt to try to solve the pressing problem of our time, the great power competition between the United States and China?
Honestly, I have such a low opinion of American executive leadership and its political parties and its foreign policy. And I really think that the only mechanism or means of interaction of the U.S. from a foreign policy perspective is blunt instruments of power, so the reserve currency or military or saber rattling with the military and this sort of thing. And the idea that there's anything subtle or elegant going on between the United States diplomatically and any other country in the world is almost impossible for me to conjure or imagine. And so I think that America looks at China as I think America feels dependent on China. America needs China to be economically strong in order for America to be strong, but it doesn't want China to be, it wants China to be an order taker, not an order maker. And so there's a sort of never ending conflict with the United States in its desire to exploit the strength of China, but never become subservient to the strength of China, which is ultimately, that something like that over time will never sustain itself. And if anything, because the U.S. corporations are the ones that ultimately create the China policy, like people talk about how China created this labor market what created the giant sucking sound to deindustrialize the United States. Well, that entire policy was created by the American banks and multinationals.
I couldn't agree more. I hate the narrative that China stole our jobs. We gave them away.
Well, we didn't give them. It was a matter of, and then we blame the Chinese because it's politically convenient, because no one wants to blame Nike or JP Morgan or Apple, who lobbied the US government to allow them to create this structure in the first place. And so any of the interaction now is nothing more than posturing by the American government, in my opinion, to continue to cater to JP Morgan, Apple, and Nike. And what's most in JP Morgan, Apple, and Nike, I say that both literally and figuratively, whatever's in their best interests, which is, access to cheap labor in Asia and all the rest of it, is what the U.S. interest that's being pursued.
Where I would, I agree with essentially all of that, except for I think the current corporate interest is not for cheap labor in Asia; it's for cheap labor. Where that cheap labor is ultimately not of terrible consequence, as long as it's there and it can do for supply chains what needs doing. And so
meaning Mexico or Vietnam.
Meaning Mexico and South America, because the pitch in the 90s ostensibly was, look, we have lots and lots of labor and there will be no shenanigans. Like, nobody's going to nationalize anything. There's not going to be any strikes. There'll be what appears to be predictability, timely delivery, peace and quiet.
We won't have to put up a bunch of nets to catch people when they jump to their death.
Yeah.
And we don't have the whole suicide PR issue.
Nobody's going to put on a beret and become a gorilla in the jungle. Like, none of these things. It'll be predictable and it'll arrive on time and everything's going to be fine. And that left South America and basically everything south of Texas less developed than it could be. Because from a transportation cost perspective, obviously, they're closer. We now see that the part where we incorporate Mexico deep into the supply chain works really well. It works really well with autos. It works really well with other things. They've surpassed China as our number one trading partner at this point. So I see more of that. And so I just think China has basically talked themselves with their sort of combativeness under Xi. They've sort of talked themselves out of this role.
Yeah, I agree with that. But again, Chris's question was, what's the interpretation of any of the sort of diplomacy at this point?
Right.
And I think it's meaningless garbage. Honestly, I don't think it's. I think visit, don't visit. I mean, I look at the U.S. policy relative to Russia and Ukraine and how ham-handed I perceive that to be relative to the damage that it's doing to Ukraine, relative to the damage that it's doing to Germany, to Italy, down the line. Like, I just don't see this as a sophisticated, or I see this as a group of people whose worldview ends literally at, the U.S. border. So they're even if they're harming their closest allies, like, there's just not a fundamental lack of awareness in U.S. foreign policy, and and the fact that it's generally run by people over 100 years old, so it tends to be through the lens of the 1940s, at a time when the rate of change is the world today is more different than it was a year ago, than the world a year ago, or than the world 20 years ago was from 50 years ago. And so America is hugely burdened by a very calcified mentality of its leadership, combined with a very limited sense of awareness, combined with the indulgence of extreme power by virtue of the reserve currency and the military, which basically allows you to cover up a lot of bad decision making.
It feels like the only person who's not over 100 who's been invited into the decision-making circle has been Henry Kissinger, who's recently complained that the Biden administration hasn't consulted him on what's happening in the world elsewhere. Dylan, it feels like this was an overtime episode, perhaps sponsored by Noam Chomsky, because we've been particularly hard on U.S. foreign policy and just being pragmatic about what we use our military and our strength for. There is an underlying degree of corporatism here in all of our decision making, and it's a conversation that we will definitely be able to have more in the future. I know it's getting late across the pond. You're so lucky to be living in Milan. I haven't been over there in quite a while. It's been a few years since we were over in Bellagio, but we are planning on making a trip again soon. So perhaps I will get to see you in town over the next few months. Dylan, before we have to wait a week to see you again, any final closing thoughts here about everything going on in the world right now?
I mean, what the hell's going on with NVIDIA? I mean, can we just get a grip on this whole situation? I mean, seriously, look at this thing. Like, what is this?
It's the future. And to think, when I was 12 years old in Staples, getting together my money that I had earned from, picking up sticks and doing yard work to buy my first NVIDIA graphics card when I was building my PC for gaming, little did I know that I had in my hands the secret to investing for the rest of my life. And I never took advantage of that or acted on it. Yeah, so shame on me.
This is one of those great, those great anecdotes of like, oh, if you invested $10,000 in the NVIDIA IPO, you would have $50 million today, or some absurdity. So anyway, God bless the stock market. I don't know what to tell you. I watched that stock the last. It was 492. I don't know. Is it? I'm inclined to call it preposterous, but what do I know? Who am I to say?
The market will do what it wants to do. Everyone, this has been another episode of Overtime with Dylan Ratigan. Dylan, thanks so much. We'll see you again next week.
See you next Wednesday.
Thank you.
All right, bye, guys.
Ilya, it was a banner day here for stocks once again. A day where you could describe the price action as scratching and clawing its way higher. Not a 2% gain, not a 3% gain, but one of those we get up by 0.5% and we bob around back and forth over the course of the session. S&P 500 closes up by 0.39% today. NASDAQ up by 0.55%. Your Russell up by 0.41%, and the Dow Jones up by 0.20. Interest rates, they come off of their lows over the course of the session. Bonds back off the highs, and so as you see yields go up, stocks come in here a little bit. The S&P 500, though, perhaps this is a continuation of recent technical efforts running into the backside of that trend line from the March and May swing lows, where we find perhaps an appropriate pause. But really, no matter how you slice it, it feels like this is a market. If it's precious metals, if you're looking at currency right now, everything is revolving around bonds. Wu-Tang may have said cash rules everything around me, but in this market, it's bonds ruling everything around me right now.
And not surprisingly, it is that same story for cash as well. Wu-Tang famously told us to diversify our bonds, and indeed, here we are. Here we are. It's an interesting thing that seems to be happening here, because if you look at the bifurcation in the currencies space, you get a really interesting story for all of this. So if you look at something like 6A, we said yesterday, you know what, these gains look corrective. It's retesting a former level of support. Well, where is it stuck now? Exactly there, with a candlestick that looks ugly, that looks like indecision, that looks like we tried to go and then hit a wall at this former level. This contrasts significantly with 6E or 6B, where you still have the case for more rate hikes. There was a German inflation number overnight here that registered a bit hotter than expected. That seems to have done a bit of help to bolster the expectation that you're still going to get another rate hike from the ECB this year. And then, of course, we got ADP from the U.S. today that helped to drive down expectations for another Fed hike. So there seemed to be a yield readjustment there. Obviously, the Bank of England has made it clear that they're going to keep hiking until either the island sinks or inflation's down, because they are deep into recession at this point. And their perspective has been, well, listen, stiff upper lip, we're going to keep going. Until inflation is beaten, nothing changes. So you have maybe a yield differential story with 6E and with 6B, but very much a worried about growth story with the Aussie and the Canadian dollar, where, like the Aussie, there's a pullback, but there's not a situation where any trends have been turned or some such thing. So you're speaking of diversifying our bonds, the market seems to be attempting to kind of hold two narratives in its hands for the dollar here. And that's maybe why what we're seeing in gold, let's say, is a little bit more emphatic, whereas what we're seeing in stocks is a little bit cooler. And when we look at rates, we see much more activity at the front end. So ZT is up much more so than, let's say, what we're seeing in ZN or ZB, where things are essentially flat. So it's sort of the flip side of the conversation we've been having last week, where it was ZB that was holding up better, but ZT that was falling, because it was a kind of higher for longer dynamic at the front end, but then greater recession risk because of that at the long end.
Ilya, we have this non-farm payrolls report coming up. It really marks a week of what's been fairly interesting U.S. labor market data thus far. Of course, JOLTS yesterday, ADP today. We're going to get jobless claims tomorrow. How much noise is there going to be in this non-farm payrolls report? We have the Yellow Trucking Company, which just shut down.
Yes.
That was one of the largest freight and trucking companies in history. We have the Hollywood writers' strike going on right now.
Yes.
We have teachers going back to school end of this month, beginning of next. There's a lot of reasons to think that this may not be a good report.
Yes.
And yet the Fed may say it's not a good report for seasonal factors, for one-off factors, right? Just like once the writers' strike ends and people get back to work in Hollywood, you're going to see perhaps an influx to payrolls, which, do you take that too seriously? No. Right. So how much of this upcoming payrolls report is going to be signal versus noise?
It'll be a really interesting thing to look at how the markets respond, because the way that they're reading these things currently appear to be relatively superficial. So they look at the number and they go. Let's consider JOLTS. JOLTS was obviously very impactful. The market looked at JOLTS and said, whoa, 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 sub 9 million. Hang on a minute now. This is maybe finally rolling over. But at 8.8 million, which is what we got, we are still very far away from the 7 million, 6 million average before the pandemic. So there's still a whole lot of wage stickiness here, because the imbalance is still meaningfully more than it's been historically. And of course, the demographics are the worst they've been for this imbalance historically. Because one of the things that we saw during the pandemic is we already were seeing a bit of a deficit. Before the pandemic, it was at about 1.5 million workers, give or take. And we already saw that there was an issue with wages starting to perk up. And that was just because baby boomers were retiring. They'd reached about that age. A large swath of that population started to go 65 and over right around 2017. So we were already there. During the pandemic, that process really accelerated. Early retirements spiked. So a ton of people have exited the labor force. It'll be a while yet to break this logjam.
So there's an interesting stat that I heard today. I was listening to this podcast, Spaces, with some of the folks over at Wisdom Tree. Wisdom Tree is an asset manager and ETF sponsor. They have about just under $90 billion assets under management, at least coming into this year. They were talking about the dynamics of the labor market, and someone on the, in the conversation pointed out that if you look at the unemployment rate to the quits rate ratio, which is currently at 1.52 as of the last jobs report, that's pre-pandemic level, right?
Yes.
You go to January 2020 and the unemployment rate divided by the quits rate is 1.52. So the labor market, for all intents and purposes, is back to the level of strength that we had become accustomed to in 2018, 2019. We had overshot that early in 2022 when that ratio was about 1.24 at its absolute low in March of 2022. And so we're now back to more normal levels. This is where we were hovering around, you could argue pre-global financial crisis, it sits closer to 2, but you stayed below 2 for quite some time. In 2017, 2018, 2019, it was years at this point. So labor market slack disappearing, or rather, depending on how you want to phrase this, the labor market's been really tight in some regards. There's a lot of people who are out of work still, but there's still a lot more job openings out there. We haven't seen that significant amount of stress come into play yet, where the Fed may say the labor market is falling apart. And I don't know if this is going to be a singular data release that the Fed turns around and points at and says, see, we were right. We're done. Plain and simple. And I just think there's too many competing narratives out there right now within the jobs data, which you and I will talk about more tomorrow. I know that you're going to do a non-farm payrolls preview.
Sure.
I'll be writing up the reaction piece Friday morning. You and I will talk about that extensively, both tomorrow on overtime and, I presume, I don't want to put words in your mouth, but I presume on macro money, given the event risk.
Oh, yes, very much so. Definitely. Which
reminds me, Mr. Spivak, macro money starts in a few minutes. What will you be discussing today?
So there is, once again, a story about growth here in parallel with the story about the Fed. And sort of the dynamic I've been watching most closely is the Fed is doing what it's doing, but in the world in which it is doing it, those actions bring us ever closer, or at least raise the specter of a global recession. And what we're going to have here coming up over the next 24 hours is, first, a set of Chinese PMI numbers. and then the US PCE report, which is the Fed's favored inflation gauge. Now, neither of these things are probably going to give us anything earth-shattering. They're going to give us the trends that we've been watching, which is China is really struggling, and disinflation stopped in the US in July. We saw this already in the CPI numbers. So the story is of the US and China kind of diverging, where China is withering on the vine and is trying to ease, unsuccessfully so far. The US is worried about stickiness in the labor market and inflation starting to go the wrong way again. And so maybe we hold rates higher for longer. So what we're going to talk about is what that divergence means for where the global economy is and what that means for global recession risk, which isn't anything good. Spoiler alert.
To watch Macro Money, you can do so every Monday through Thursday, 5:30 Eastern, 4:30 Central Time. Of course, it's preceded by overtime, 4:30 Eastern, 3:30 Central. Ilya is also on First Call, Sunday evenings, 5:55 Eastern, 4:55 Central. You can follow him on Twitter or X, whatever you want to call it these days, at Ilya Spivak. You can follow me there as well, at CVecchioFX. Futures Power Hour is every Monday through Friday, 1 p.m. Eastern, 12 Central Time. Ilya will be joining us this Friday, as he always does, but we'll be doing a special post-non-farm payrolls breakdown and what it means for Fed rate hike odds moving forward. Let Me Explain is on Tuesday mornings, 9:40 a.m. Eastern, 8:40 a.m. Central Time. I was with the two Batmen yesterday, Nick and Tony, to talk about what Jackson Hole means and why bonds may have bottomed. And with that, overtime is now out of time for today. We'll be back tomorrow, same time, same place. First, a quick 23-hour break. Until then, good luck trading. For Ilya Spivak, I've been Chris Vecchio. Up next, Macro Money with the man himself, Ilya Spivak.
Are you there, folks?